Hi, everyone. We're going to wait just a minute for everyone to join in, and then we'll get things started. All right. Good morning, everyone. Thank you for joining us today for Election Impact: Safeguarding Wealth During Uncertain Times. In this session, our team will explore historical insights on elections and administrative changes, anticipate market movements pre and post-election, and analyze the implications of election outcomes on portfolios. We do have the Q&A feature enabled through the button at the bottom of your Zoom screen, so please feel free to submit questions, and if there's time at the end of the session, those questions will get addressed. You can also submit any questions to us via email at rwheeler@yoursummit.com, and I will display that email address as we will near the end of our session today. Before we get started, I would like to introduce our speakers. Rick Wheeler is a senior financial advisor for Summit. Rick's aptitude in investments, employee benefits, and insurance spans various industries, including nonprofit, industrial, real estate, and healthcare. Rick believes that relationships are key, and he's passionate about not only being a resource, but an advocate for his clients. Next, we have Peter Reardon. Peter is the Director of Retirement Plans at Summit. Peter focuses on researching investments and capital markets. He goes beyond surface level data to understand the underlying issues that drive investment performance. And his knowledge of securities and the retirement plan landscape allows him to develop strategies that are best for your business. And with that, I will pass it off to Peter and Rick to get us started.
Thank you, Matthew. There are a lot of concerns that people have today. The economy, inflation, federal debt, the leadership in our country, the division in our country, our electoral progress and its integrity, and so much more. And those concerns are across party lines. And in many ways, they are valid, but they are not new. Thomas Jefferson, for anyone who has seen the play Hamilton or remembers this from their history classes, was fiercely against a central banking system. Today, there's still so much debate around the Federal Reserve. George Washington commented on the distemper in the nation, James Madison on the debt. These issues, while they take slightly different form, go back to the beginning of our nation and are not new. We want to use this truth as a backdrop to many of the items that we are going to discuss today. We're so appreciative of everyone attending the presentation and taking the time out of your day to spend just a little bit of time with us discussing the capital markets, the election, and the portfolio impacts in our current environment. And at Summit, we care deeply not just about the numbers aspect of finances, but also the emotional impact it has. Our wealth, portfolios, our security is crucial to an effective individual financial plan or retirement plan. Now, you will hear me say a lot of numbers today too, but our goal is to put context around those numbers and hopefully give some encouragement and confidence with the uncertain times that we're in. Something you've probably heard before, but I think is a crucial point of application to what we're going to talk about. I saw this study pop up again recently that 85% of the things we worry about never happen. And of the 15% of things that do happen, we actually find that we handle it better than expected, or it taught us a lesson worth learning. So that means 97% of the things that we worry about either never happened or it's handled better than we thought in the process. So why is that important? Because we are in uncertain times. There are things that people are fearful about in our economic and political environment. In this profession, Rick and I hear it all the time, but so much about safeguarding wealth is simply about the courage, the principles of courage and consistency when investing, not overreacting, and just having a suitable financial plan for your goals. So today, what we really want to speak to is why can we be confident in investing despite uncertainty. And to be clear, what I'm not saying, and those of you who have heard me speak before have heard me say this multiple times, I'm not saying that elections don't matter, that the people that we elect and our leadership doesn't matter, that the policies they implement don't matter, because they do. They absolutely do. But I think as we're going to show today, markets are shockingly good at navigating the various environments in this country. As Matthew mentioned, Rick Wheeler will be helping me out with these discussions, and he'll be providing his commentary, wisdom, and experience throughout the presentation. So Rick, thanks for being on as well today, and I want to get you involved early with any initial thoughts that you have and want to share, and even with this slide specifically, and why this should actually encourage us.
Absolutely. Thank you, Peter. And quite honestly, I love this slide. I love the depressing quotes of our founding fathers. They were ahead of their time, and fear and worry about what the future might hold for obvious reasons back then. But we still experience some of that same fear today. But it does kind of oddly gives me a sense of comfort to realize that things haven't changed in many ways, that within our free market system, one that they imagined, the ability for us to have the freedom to succeed within our society, that even 250 years ago, they battled that same skepticism and fear of any economic failure of the government or for the citizens themselves. So even though we're experiencing kind of some unique battles, we've had unprecedented times over the last few years. That's a term I've heard quite honestly more than I ever expected that I would use myself. But I find it encouraging that even in some horrible times in the past, that cynicism that drove them, that still drives us today, that we've always had one thing to rely on, that even back then they recognized that there was something that was going to set America apart. And there is one thing that I still bank on today, and that's American ingenuity. That every problem that's created, even if it's our government maybe creating them sometimes for us, we always come up with solutions, and we have the freedom to innovate and create and quite honestly solve the problems that were maybe created for us in order to address whatever the issues we may be experiencing today. And just like today, we're worried about wars, we're worried about maybe the next pandemic. Every time those things happen, we do have a spike downwards, but it's that ingenuity, the American consumer, that I bank on to solve those problems. And that's where when I see this, that's where my brain goes, is that I'm going to rely on us to solve those problems, come up with ways to keep the markets moving and flowing in the overall right direction with a few hiccups along the way.
Yeah, I absolutely agree, Rick, and completely concur. But now, before we get too far into the information and the presentation, I do quickly want to discuss the current state of the asset markets in the economy, because to look at where we're going, it's important to understand where we are currently. And so generally, markets have been on a great run here since the beginning of 2023, and the economy has managed to hold on and have positive growth. But like many economic and market environments, there's good news and bad news. There are tailwinds and headwinds. So starting with the good, the S&P 500 has managed to return about 19% year to date. The bond market, 4.5%. Gold, 28%. International stocks, 15%. Inflation has fallen down to 2.5%. The economy has grown at a pace at 1.5% in Q1 and 3% in Q2, with expectations to be right around 2% at the end of the year. And then the Fed has begun to cut rates, with a 0.5% rate cut in September and more expected this year. So generally all positive things. On the flip side, while markets have done well, not all asset classes are created equal. We did see things rotate a bit in Q3, but still markets have been driven by a certain subset of stocks, and valuation across those parts of the market are higher. With inflation, it has come down, but it is still 50 basis points above the Fed's target. And we are dealing with the ramifications of higher prices from 2022 and 2023. There are still parts of inflation like shelter that have remained a bit sticky. The economy has shown some signs of softening in the labor market, with unemployment picking up and more individuals looking for jobs. And there is also some concern around the timing and messaging of the Fed's action. Did they cut soon enough? Did they raise rates too much? And how are they going to effectively bring them back down? So we describe the state of the economy and the markets as generally positive, but not without challenges or risks by any means. What we really want to speak to is how might the political changes impact us moving forward? And so to do that, there are three questions that we want to address. What does history say about the markets and economy through different administrations, Congresses, and periods of time? Why have the markets reacted the way that they have over longer periods of time? And then finally, what does that mean for our portfolio? So speaking to the first question just a bit, and even as it relates to the concerns of the nation being consistent over time, we actually see returns in the market have very, very similar dispersions throughout different administrations. In all reality, almost every president listed on this page experienced a downward 15 to 20% in a given year, or as much as a positive 40%. Let's just take the past two administrations as an example. Their rolling daily one-year returns throughout their years in office are almost identical, both experiencing significant market pullbacks. See Q4 of 2018 or Q1 of 2020 for Trump with the pandemic. See 2022 in the inflationary environment and interest rate rising period for Biden. The reason we think that this is so telling is because while different administrations deal with the challenges of our nation differently, there are so many outside factors that affect markets. But yet, because markets are resilient, it makes the returns through administrations actually look very consistent. We know that these presidents have had different policies, but over the long term, through their tenure, market returns look relatively similar. Rick, I don't know if you have any other additional comments there.
Yeah, I'd like to pipe in just because I've been around long enough to at least been involved in some of these guys, most of these guys that you see on the slide. And as someone who can even remember the Ford presidency, my dad imitating Richard Nixon, saying, "I'm not a crook," doing a very good impression of that. And those are some of my earliest memories about politics and some of where those formative years came along. I remember also something that sticks with me historically was the Carter years, hearing my father rant and rave in a 1.5 hour line just to get a few gallons of gas. And I still remember, and when my father passed, looking at his old mortgage statements for 13% on their first ever house that they bought after we moved from our rental home. And I also remember that same time period, 78, 79, we would typically have that Friday night going out to eat dinner, and we just didn't have money. We were like most American families, especially living mostly on one income. My mother was a preschool teacher. I remember going to the A&W root beer stand on Friday nights was our favorite place to get a burger and fries. And through the Carter years, we split 2 Papa burgers. And I remember whenever a year later we went and my dad allowed me to get my own baby burger. Now that's kind of humiliating for an 11-year-old kid at the time. But the reality was I was thrilled with my own baby burger. It was just kind of a sign of the times as we started to see interest rates come down, a little bit more money in our pockets. Of course, back then, nobody had a lot of credit card debt because interest rates were so crazy and so high that it's only more recently, these last 20 to 30 years, we've seen not just our family credit debt, soul-killing debt go out of control, but it's happened to our entire nation. So we don't even really talk about that and maybe the effect that would have on the future. But we do look at time. We see Vietnam, 9/11, COVID. You see some of these spikes down and then spikes back up immensely. It doesn't matter the tragedy or the catastrophe that has occurred or been created. We have always found a way for that spike to occur. And that's what I still bank my viewpoint going forward on.
Yeah, absolutely. And even speaking a bit more to just the unpredictability of markets during different administrations. I think a great example of this, and truthfully a pretty amusing example, is when you compare the clean energy stock index versus the oil and gas index in the Trump versus Biden administrations. Trump has generally been seen as more of a oil and gas friendly president, while Biden seen more as a ESG, clean energy friendly president. But the performance of those equities during each of their tenures does not necessarily align with that. Not that it isn't true, not that Trump isn't more friendly to oil and gas or Biden more friendly to clean energy, but the point is that there are so many other outside factors that contribute to how stocks in general are doing and which stocks do well. If someone would have made the assumption that ESG is going to do better for Biden and then oil for Trump from a stock returns perspective, that wisdom may make sense, but it actually would have been wrong because things like interest rates, geopolitical factors, et cetera, are what really are driving these returns, not necessarily the viewpoint or opinion of the president. So the broad point when we extend this to the entire market is that markets are resilient. Markets have done well through both parties in control of the White House. What this slide is telling us is that since 1900, the portfolio that stays invested during both parties' period of control way outpaces a portfolio that was either invested in just times of Democratic White House control or Republican White House control. And I do think that this speaks for itself and tells us that even as we go from administration to administration with different policy, markets trend upwards without one bias to a certain party or another. And I know that that's a little tough for those of us who are opinionated on different policy, but this should give us confidence in investing through perceived uncertainty. Rick, is that your interpretation as well?
I totally agree. And you mentioned policies matter. I 100% agree with that, that quite often our policies are in spite of whoever is president. We see that whenever we do have a little bit of gridlock, it's very beneficial maybe on taxation and other areas. It may not be beneficial on certain other parts of our economy, but it impacts so many areas that forgive me for using the word trickle down, but over time, we're going to have an impact, whether positive or negative. And it may take years, if not a couple of decades, to experience whatever the results of a today solution might have on tomorrow's economy. So we have to keep that in mind. I think what this slide tells us is that, maybe it's good that we're changing every so often from one to the other. Maybe one administration's creating the problems that our kids tomorrow are going to solve in ways we can't even imagine. So if we look at the last few years as grocery prices and gas and other things have gone up, many grocery things at Walmart's up 100% in the last 4 years, that of course is going to have an impact. So just the shipping, the creation of those products, it is a trickle down of the costs that finally hit us as consumers. So we can focus on those things, but we also recognize, just like with war, whether we see the benefits at times or not, I'm not promoting it at all. But the reality is when there's a war overseas, whether we're supportive or we're involved, that tends to drive economies historically as well. And we've got some of those going on right now. And America, again, is involved in coming up with solutions. We can talk another time about the morals of that and whether we should be involved in doing that, because I definitely question many of those. But primary note, I'd say it doesn't really matter as much who is president because Congress makes the laws. Even though presidents recently have been using that mighty pen, for the most part, it's the lawmakers maybe that's going against the dictates or the desires of the president or even the people in many cases. It's in spite of that if you stay sanely, let me use that word, sanely invested, no matter who's president, historically, it has benefited you very well.
Absolutely. Absolutely. And I couldn't have said it better. And moving on, thinking about why has the market done so well through different administrations? Because it can be counterintuitive and striking how returns over time, despite the concerns of our world and the changing leadership, how returns are so consistent. And so we do need to think about the why. Why are markets so resilient? And reason number one is that the U.S. economy really isn't significantly structurally changed through administrations. Now, don't get me wrong. There are changes to taxes, regulations, et cetera, but its composition is still consistent. Looking at the right side of this slide, also just because there's one party in control, one party rule does not mean the number of significant bills passed increases. There are more moderate individuals on both sides historically to limit this. I mean, recent examples see Joe Manchin, see John McCain. And there's so much that has to happen for a piece of legislation to go through. The more radical the legislation, the harder it is to pass. So this should actually give us confidence in consistency, which markets like, and it's a huge reason that markets have been resilient. Another reason markets have done so well over time is because there are many different factors, like monetary policy, that affect markets a lot more than maybe our president does. Interest rates, foreign exchange rates, valuations, etc. We saw the Fed's rate hike cycle in 2022 drastically affect markets. We've seen some presidents benefit from historically low valuations, which has contributed to returns. financial conditions that have built up for years, and Rick, I think you hit on this really well. Financial conditions that have built up for years, if not decades, have a big impact on markets down the road. And so typically, doesn't necessarily matter who the president is, but if financial conditions are easing, returns are good. Next, the market doesn't actually care that much if we as a country like a president. Now, historically, if a president's really unpopular, which typically correlates with a severe economic hardship or unprecedented events, markets don't react well, but they actually do best when a president's approval rating is between 35 and 50. You'd think if the approval rating is higher, markets feel better and do better. But again, so many outside factors impact returns, and markets are somewhat agnostic to whether or not you like the president. Rick, any thoughts there?
Yeah, I'd say that markets don't care. You're correct, and sentiment can be driven by many ways. I'd ask the question, maybe, is it public sentiment and pessimism that drives markets volatility or drive them down? Is it maybe the poor leadership of Congress or the president, combination of those, or maybe it's the media? If it bleeds, it leads. If it's something negative, fear sells, and that is what's going to get pushed. So if we're being inundated, whether it's from maybe the radio or printed media, TikTok, you name it, negativity and fear sells. And it's something that is pushed out there to grab eyes, grab likes, grab attention. But the truth is, it causes sentiment to grow one way or the other. We're a knee-jerk reaction society, and we tend to overreact one way than the other. That's why we have volatility, which creates opportunity. And when we see that dip, that decline, that's the time to buy. It's what Grandma always said: you buy low, you sell high. So we're creating opportunities. If we look at 9/11, we had to rebuild. We had to rebuild our military. We had to rebuild buildings. We had to rebuild a lot within our society as we combated terrorism. But it led to an economic boom that literally lasted for more than 10 years, even up into more recent times through 2022, because COVID glut that occurred. It created a long-term sustainable, once again, unprecedented growth within our markets. So when we look just at the negatives, at the horrible things that are coming, just looking back at 2008, the banking, savings, and loan crisis, we could debate whether that was created by Congress, who forced loans upon banks and savings and loans institutions to get people who could not afford to pay it back. And it caused a problem. But because of that, after 2008, 2009, we've seen again, we've had to come up with better solutions in order to address those problems. And it created an economic boom that, for the most part, we're still experiencing today.
Yeah, absolutely. And just finally, thinking about, okay, why markets have done well over time, I think that this might be just a little bit of a controversial statement, but markets have tended to do well because generally our world and standard of living is improving. Since 1820, global poverty has continually decreased and it's steadily disappearing. We've gone from about 10% of the world not in extreme poverty to about 85% of the world not in extreme poverty. And that's a major reason for market advancement. Speaking of standard of living, since 1900, the amount of discretionary income in the US for the average citizen has grown significantly. It means more money to invest, to buy goods and services, and contribute to a growing economy. The amount of violence that we've experienced has radically been reduced as well. That seems a little strange considering the weaponry we have, the horrible things we hear about going on in the world today. But in all reality, we are freer from deadlier conflict more now than ever. And then technology has vastly improved our standard of living. There's this fear that it might, take jobs. Too much technological advancement causes job loss and actually hurts the economy. But in reality, the unemployment rate has stayed steady through all kinds of advancement. Aircrafts, internet, Uber, etc. have all came and gone and contributed to the economy, not damaged jobs, and really actually helped expand long-term job growth. So when we think about why have markets continued to climb, even when someone who we think should not be in the White House is there? It's because American ingenuity and investment continues. New and innovative ideas across all sectors and industries continue. There will be opportunities that pop up that we can't even imagine, companies that'll be experiencing great returns that we've never even heard of today, despite who's president. And that's why markets go up over the long term, because of that American ingenuity and investment that's been strong and that'll continue to be strong. And even speaking of American ingenuity and exciting opportunities, I know Rick has gotten plenty of questions on AI, which is seen at the bottom right of this slide. And many times we get questions on what are some of the most exciting opportunities on the horizon. And I do think I think AI is the big one that comes to mind. Obviously, there are concerns and excitements with it. Some concerns like job loss. I'm not personally as worried about. I believe the economy is going to be able to adapt, but concerns around transparency, algorithms, privacy and security, biases in AI. I think those are real issues, and we will have to adapt and learn how to harness it. From an investing perspective, I'm always an investor who's price conscious. When there's a lot of excitement in the market about new technologies, that's great. But it also means a lot of growth can be priced into a stock, which can create more volatility. So I think how we go about investing in these things has a lot to do with suitability. And there are a lot of things out there, as I said, that we aren't even aware of yet that'll drive the market. And a diversified approach can really help make sure we get exposure to all of those opportunities, whether it is tech and AI, or whether it's energy, whether it's healthcare, et cetera. So, Rick, what are your thoughts on opportunities in AI specifically?
Yeah, absolutely. And I just like everything else with the knee-jerk reaction that we tend to have, our industry has experienced a lot of concerns about AI. I know about 2 years ago, I started getting requests to maybe move over with companies that use AI. Well, the truth is, we've always really used AI since it was really a thing. We use algorithms and predictive analysis and historical tracking and looking forward into the future and valuations of companies. So there's already those algorithms that have been there, that the primary money managers and companies that we prefer to use have had those going for a couple of decades now. So that's not really a new thing. The new thing is allowing a bot to actually make trades or transactions for a client. And there were a few big companies you would say that's the top of the financial services industry, that have had lawsuits over the last few months. And they backtracked from having AI actually make investments for clients, because again, it's all about fiduciary control. It's about having advisors and people that know not just your funds and maybe which ones to pick at the right times. By an aside, they weren't doing any better than the regular advisors were, but they also lost that human element. It's all about compassion. It's about knowing the family, the individual needs of that client, of you, and making sure that you're aware of those goals, those plans for the future. And what happens if mom has a stroke? And if I'm the advisor, I know what that family needs, what the next steps should be, what the expectations are. And if I'm doing my job accurately, I'm going to be able to help with that. So whether we're looking back at automobiles, changing to taxis as a service, to Uber, or dining in to dining out, to DoorDash, telegrams, to iPhones, just the technology over time. And AI is just a part of that this is going to create entire new industries that will allow us to move into the future, I believe, again, creating whole new industries, whole new ways of investing and saving money. It has created new ways for me these last few years behind the scenes to be able to provide more protections, less risk for the same reward for my clients. So I guess I'd say that as long as we don't see Arnold Schwarzenegger coming in saying, I'll be back, then I think we're going to be okay. So all should be well.
Absolutely, Rick. Absolutely. So then finally, what does this mean for our portfolio, and how does this information inform us on our investment strategy? And we believe that the answer is simple: planning, either sticking to, updating, or creating a financial plan. If you have a great financial plan, great strategy, we encourage you to stick to that, to have the confidence in that plan and not let the election or political environment deter you away from that. What we generally would not advise is attempting radical overhauls or changes like, for example, moving all assets to cash based on who wins in November. Based on market conditions, a nimble and flexible plan and portfolio can be very important. And there are so many times when updates and changes are necessary, sometimes more often than not. but the overall strategy should be resistant to changing administration and by no means depending on that. Specifically, as this slide shows, market volatility historically does pick up a bit prior to the election. Markets tend to get a bit jittery in anticipation, more ups and downs. But after the election, markets tend to cool off, volatility tends to go a bit lower. And an investor taking advantage of that and remaining consistent through that is historically rewarded. And that's true through both parties giving up and gaining control of the White House. Another application for our portfolio too is that stocks and earnings have a 97% correlation over the long term. So let's not overcomplicate things. Personally, I believe American companies and companies around the world will continue to have growing earnings and profitability over the long term. That means the market as a whole moving up as well. Now, we know that a lot of equities have some growth priced into them, have a lot of growth priced into them, which means earnings will have to be really, really strong to normalize valuations. But that's why diversification into different parts of the market and different styles of investment is crucial, because not all stocks at all times are made equal, but the market as a whole over the long term is driven by earnings. So despite uncertainty, what we would say are the takeaways for portfolios: planning, diversification, and consistency in investing, either sticking to, updating, or creating a financial plan. Our problems aren't new, but they certainly feel scary. Despite this, though, markets have continued to do well over the long term because of the innovation, market factors, relative economic stability, and improving global conditions that we've seen. Over any 3-year period since 1926, a 60-40 portfolio has a 90% chance of generating a positive return. History does not repeat itself, but it does often rhyme. And we would argue in trusting in the track record of markets over the long term, no matter the outcome in November. So, Rick, what are your final thoughts?
Yeah, I'd say that personally with my clients, that the only ones that tend to hurt themselves or get hurt are those that do knee-jerk reaction again out of the market whenever we've had a few bad days or maybe a bad year even. And I want everybody to remember that the majority of the years where the majority of growth occurs is within a handful of days during the entire year. If you take out the 10 best days in any year, you'll probably make nothing. So if you miss those 10 days, and if those 10 days are in a 2 or 3 day week period in 1 month, when you've got everything moved over into cash or the bank, so to speak, in the mattress, you're going to miss the growth. And that's where those folks will see a marked decline. Now, I do have an understanding and a concern myself with just some of the things within our market environment, the world right now with the economy changing some, going more digital. Again, fears of war overseas and other things that will have an impact, printing of money, the interest rates hike happening so quickly. I do believe, again, we're addressing it maybe a little too late, but we are doing some of the things correctly. And as Peter was addressing, we do see after the election, people realize the world hasn't fallen apart those first 2 months after whoever wins, and people start to really push money back into the market. You want to be a part of that. You don't want to be the latecomer. You don't want to bet on Seabiscuit just because Seabiscuit won a lot of yesterday's races. You want to look at today and say, what is it going forward? Is it a good time to be in the market? And most all the time it is. Now, with that said, I do have a lot of clients that I've been shifting over or currently invested in things that have buffers or protections. That provides additional peace of mind. It helps me sleep better at night. That's one of those innovations that have occurred over the years and the decades, especially as we've had bad years. And all that means is there are strategies, a handful of strategies out there with thousands of different types of investments that can provide 10, 15, up to 100% protection against losses. And that historically has paid better than what you were getting a CD or in the bank. And in certain years, dramatically more returns. So I would highlight the fact that when the markets drop and you lose 20% in a bad year, like most people did in 2022, that you need 25% the next year in 2023 just to get back where you started. You didn't make any money in those 2 years, but if you were invested in these types of investments I was talking about just now, that you would have lost about 5% instead of 20, and you would actually be up on a $100,000 account, a total of about $12,000 more. So you would have a 12% return over 2 years because you had protection against those negatives. And those are some of the ideas. Those are some of the questions that I tend to get from my clients as they prepare for retirement or just want the ability to sleep better at night, not worrying about their financial future.
Absolutely. So Matthew, I think that's it for us. We'll pass back to you.
Well, thanks, guys, for all the great information you've given us so far in this session. I think we've hit some critical points that are important for people to make note of. But in addition to that, while we have time, our team has received some questions that I want to make sure we address for our audience today. The first one that I believe is important to make clear is, what impact could tax policy changes have on the economy and markets?
Yeah, absolutely. And Rick, I can start with this one. And this is of course a great question, and one that is necessary to think about considering the expiration of some of the Trump tax cuts at the end of 2025. I think it's a multifaceted question because, frankly, yes, I believe that higher taxes at both the individual and corporate level is a potential headwind, a potential challenge to economic growth, especially in the shorter term. If the individual tax cuts expire and go back to pre-2018 levels, we're talking about most Americans paying between 1% and 4% more in personal taxes. So that maybe doesn't seem like a huge number, but it matters. And Americans will need to reassess spending and adjust to higher taxes, which may equate in less broad spending in the economy, which for a while was really propping up our broad economic growth. So really the implication for corporate taxes, which is an interesting conversation, because the Tax Cuts and Job Act made the corporate tax rate 21%. It's about 35% for a long time before the reduction to 21%. And depending on who gets elected, that can certainly be revisited and attempted to be raised. I would also argue that is a short to midterm headwind and possible challenge to broad economic growth. Maybe even more so than possible individual tax hikes, because I think that even if the Trump era personal taxes aren't extended and taxes are raised, those raises may focus more on those making over $400,000 or so a year. And then it's possible a lot of the reductions from the Trump tax cuts for those under that threshold may stay in place. So the increase will still have impact, but that's just a thought. In summary, though, yes, whether it's personal or corporate tax increases, yeah, that could absolutely be a drag on economic growth. The flip side to that argument is the federal debt conversation. And call me old school, but I do think deficits matter, and extending or furthering tax cuts will increase the debt, which could have more serious long-term ramifications on the economy. But no matter what side of that fence you fall on with those arguments, I would caution against using those potential concerns as a reason not to invest or change your portfolio too much from an asset allocation standpoint. You always want to work with a great financial professional, my plug for Rick, who understands ways to take advantages of tax changes in different investment vehicles based on tax implications. But from a pure market performance perspective, we can use the Obama administration as an example. Taxes generally went up and markets still did pretty well. So I think it's too hard to predict how those legislative changes might impact markets. And again, I think trusting in the long-term performance is what history teaches us. Rick, any additional comments there?
Yeah, I'd say that my primary role for many clients is I don't want to give any more tax money away than I have to. And so a big part of what I do and on my team here when we're doing financial planning, retirement planning, is to address taxes and making sure that the overall strategy provides tax efficiency, tax loss harvesting to offset those gains, being very, really mindful of doing it in such a way that we might be able to increase the returns while paying less taxes at the same time using some of the different strategies. And one of the questions that I tend to get that really does pertain to this whole American consumer, American ingenuity. And one of the things that I addressed earlier was the buffered type investments. That's just one of many of the newer concepts and approaches using some direct indexing. I know over the years we've heard being able to invest directly in indexes. Of course, you're going to end up having to pay some fees and things. So you won't quite match the S&P 500, other indexes on your own. Of course, using advisors, that always becomes a part of that conversation, but using direct indexing where they're using a very active approach to managing the taxation in order to match, if not even beat, the different indexes with less risk, because now you're cherry picking, you're picking the best price to earning ratios of those companies, those that pay the highest dividends. Instead of buying all 500, they're buying maybe 200 or 300 of those individual stocks, and allowing us regular folks with as little as $1,000 invested to do it. You don't have to be the millionaires to invest that way anymore. So those are some of the solutions that we can use on top of the fact that we've got certain no-fee annuities that have lifetime income, that has no downside risk in when it comes down to performance. 0% is the worst you can do in some of those. Using the buffered ETF funds, using UITs and other types of investments that you probably would have questions about, might be intriguing, and we can have those conversations. So if we can reduce your risk, maintain a similar, if not better reward, that is how we try to approach things. And again, it's very personalized. Everything that we do here at Summit for wealth management, for investment management, is really planning for the next 10, 30, 50, maybe 100 years, well beyond you, and establishing what your legacy and your planning might be, and to do it as tax efficiently as possible in conjunction with your CPA. So I just want to be able to address that, and let anybody who is interested that has questions, you see my email there, feel free to reach out with those questions. I'd be happy to address those.
Thank you guys for the insight. And one more that I'm sure many of us would be interested to know, and I think, Rick, you touched on this a little bit towards the end of the presentation. Are there any specific types of investments that help us protect against losses in the market that you have been seeing, or maybe that you've even been using yourselves?
Yeah, those buffered ETFs and the annuities in general were something that I didn't touch much in the past. They had earned some negative press. There were lawsuits. Money would go back to the annuity company. There were 3% and 4% fees built up in those. The newer annuities are 0%, 1%, ones that I use, and you get, if you live 30 years, you're going to get double, triple, quadruple your investment back out of that, as well as some other benefits. So I use some of those for select people, but as folks get near to retirement, those buffered ETF funds have become very attractive. Lower fee, the ability to provide a 10 to 100% protection against losses in those down markets. There's some other benefits to those kind of approaches as well. And like I mentioned earlier, those direct indexing approaches, if you got money you don't need to touch for 1 to 5 years, those will have the 10 to 100% protection as well, with some very good upside potential. So if you've got questions on those, of course, reach out on that. Thanks for that, Matt.
Sure thing. Yeah. Thank you both, Rick Wheeler and Peter Reardon, for your time and sharing this timely and valuable information with us today. And we'd like to thank all of you for joining today's session. To look ahead, mark your calendars for our final quarterly webinar of the year, titled Financial Literacy 101, which we look forward to holding on December 5th, 2024. Please also be sure to follow us on social media to stay up to date on market news and upcoming events. And if you have any questions from today's session, or if you would like to be connected to a resource at Summit, you can contact us via email at rwheeler@yoursummit.com, as well as marketing@yoursummit.com. For now, thank you all for joining us. Have a great rest of your day, and we'll see you next time. Thanks.